everyone, welcome back to the Chain Reaction Podcast. I'm your host, Tom Shaughnessy, a co-founder at Delphi Digital, where we're 5 full-time analysts focused on institutional crypto research. If you aren't a subscriber, you're missing out, so visit the site while you're listening. One quick housekeeping item. This podcast is strictly informational and educational and is not investment advice or solicitation to buy or sell any tokens or securities or to make any financial decisions. I may personally own tokens that are mentioned on the podcast, and you can view the show notes for our full disclosures. With that out of the way, today I'm thrilled to have on Will Martino, the CEO and founder of Kadena. For those new to Kadena, the company describes itself as offering the fastest, safest, and most scalable hybrid blockchain technology stack for entrepreneurs. We go through Will's history as the lead engineer for Juno, JP Morgan's blockchain prototype, all the way through the promise of Kadena, its public blockchain launch by year-end, and its focus on having a hybrid blockchain architecture for real business use cases. There's a ton of great insights in this podcast from someone who's been in the weeds for years and used all of those insights to build a new platform. With that, let's jump in. Hey everyone, welcome back to the podcast. Today I'm thrilled to have on Will Martino, founder and CEO of Kadena. How's it going, Will?
It's going really well, Tom. Thanks for having me.
Yeah, thanks for hopping on. You guys are local, based in Brooklyn, right?
Yep, currently sitting in Gimlet's old space, which is in the same place as Genius. We're out in Gowanus.
That's awesome. Well, I guess local to New York. I mean, crypto's global at this point, but let's dive right in. Give us your background and how you got started in crypto.
Sure. So I have a pretty weird origin story for crypto, and it's that I was actually at the SEC working on a quantitative examinations team. Basically, it's this internal startup that got built at the SEC to build a bunch of forensic data analysis tools for the government to use for exams and enforcement actions. And when I was there, Valerie started the cryptocurrency working group, and she needed a tech lead for that group who didn't own any coin and understood the technology and had the relevant clearance. So I raised my hand and joined the group, and that was the first time I started getting paid to work on crypto. And after that, I kind of got tired of working for the government and wanted to go and learn some new things about some new languages. So I ended up at JP Morgan in their emerging technology group, and that group quickly became their blockchain center for excellence. So I met my co-founder at JP Morgan, and we built JP Morgan Coin version 0. It was this private blockchain called Juno that was open sourced to Hyperledger before we left and founded Kadena.
Wow, that's awesome. What was the vibe like inside JP Morgan at the time? Were you like screaming at the wall about this stuff and how awesome it was? Or was it more of, it was a really progressive environment at the time?
So my personal take up until Ethereum and smart contracts was crypto's interesting. I can see some of the use cases, but I don't really see how this technology goes from where it is to being this incredibly dominant, highly adopted thing. And it was smart contracts for me that made me shift my perspective. So, inside of the group, we were doing some AI stuff, some machine learning stuff, just basically a bunch of R&D, but also vetting a bunch of vendors. That's why the group was built. Everyone wants to sell to JP Morgan. You need good technologists inside JP Morgan to figure out the good from the bad and if the vendors make sense. So you found these R&D groups. You give them the opportunity to spend 80% of their time doing R&D as opposed to vendor vetting, because usually someone like me, it'd be kind of hard to pay me to be interested enough in just vetting vendors all day long. So Ethereum launched and people started coming to JP Morgan with these platforms, these enterprise blockchain platforms. And most of them were nonsense. We didn't really see anything we thought would be appropriate for enterprise use. But the potential of a smart contract-based private blockchain for enterprise use cases was something that was just screaming at us, and the entire group saw a bit of the potential of it. The question was, okay, which route do we go? Do we go we're going to rebuild something totally from scratch, or are we going to go and take Ethereum and try to make it work for enterprise? The part of the group that Stuart was running that desk that I was on, we did the from scratch version. We went and built Juno by starting off of this project called Tangaroa, which was a Stanford research project on making a Byzantine fault tolerant raft. And very quickly, I was able to take that, put on top of its scheme, just a normal programming language, and have a very rough sketch of what a high performance private blockchain would look like that ran a smart contract language that was better than Solidity. Then the other desk did what has ended up becoming Quorum, and a number of different places have tried that route of taking Ethereum and trying to make it appropriate for enterprise use. The problem is that once you get past simple things that can be modeled to tokens, the technology stack that Ethereum is built on wasn't designed for enterprise use, so it doesn't really service those use cases. So when you try to bring it into enterprise, it just doesn't do enough.
That makes a lot of sense. I mean, so you were basically reviewing hundreds or potentially thousands of vendors that approached JP Morgan. Is that correct? And that kind of influenced your views before you started Kadena?
Oh, yeah. I wouldn't say hundreds or thousands, maybe in the 50s. There just aren't that many blockchain platforms back then. But everyone from Vitalik to Digital Asset to Exani to TradeBlock and all of these other players came through. JP Morgan was part of the kind of the founding group for Hyperledger, was in the initial conversations for R3. And that period of time that we were at JP Morgan, in retrospect, was this amazing period of market research for Stuart and myself. We got to see everyone's technology. We got to tear into the assumptions that are baked into it, what they are and aren't able to do, and see all of the requirements when you try to actually take that technology and apply it to a real world use case. Simple things like being able to upgrade a smart contract without having to hard fork your network is just something that Ethereum wasn't built to handle. That concept needs to be added through the EVM, and as everyone knows, the EVM isn't the safest thing, so sometimes you actually just can't upgrade a contract. Or being able to have more than 10, 20 transactions a second, or have more than a certain number of servers, or have it plug into existing back office databases. Just a myriad of questions that we had that we knew we needed to answer to be able to say for sure that we could take this technology, go to the head of the line of business at JP Morgan and say, this technology is ready for prime time. You can put your application on top of it. It will work. It will make you money, and it will make you money both by lowering your compliance costs and just your upkeep costs, but also by dramatically increasing the rate at which you can bring new products to market. And we had to leave to go and have the space we needed to go build that technology because JP Morgan just wasn't the right place to do it.
No, that makes a lot of sense, and that's interesting. And it's great that you guys had that much time and you got to review that many projects to influence what you're building. So before we move forward, just give us the elevator pitch on Kadena. What are you guys? What are you trying to solve? Just so we could frame the conversation.
Sure. So the quick elevator pitch is that Kadena is a blockchain company that has had this unwavering focus on business applications using blockchain technology. We started out looking at and solving enterprise blockchain. We solved it early, actually earlier than I think the market was ready for. Now that we see Libra and we see Figure and we see JP Morgan Coin coming to market and being talked about, we see that, okay, enterprise blockchain is definitely going to be a thing. It's not really up for debate anymore. Nonetheless, we solved it a few years ago and have been kind of waiting for the market to catch up. But in so doing, we built a smart contract language called Pact, which is built for servicing the most complicated and sophisticated enterprise use cases you can think of while being understandable by lawyers and executives. As a result of that, it is also a formally verifiable language. You can actually write little annotations in the code that you write in Pact, and it will be turned into math and formally proven. Now, when we were solving enterprise blockchain, we had to build a high-performance private blockchain called Scalable BFT. This comes out of the Juno and Tangaroa lineage of consensus protocols that Stuart and I have worked on. And then we put Pact, our smart contract language, on top of it. When we solved enterprise blockchain, we, after the first year, pretty quickly realized that, we're going to need to put this smart contract language on a public chain. So then we started working on what has become our hybrid blockchain platform. And that really is the future of blockchain. It's not public, it's not private, it's a fusion of both. You need to be able to service everything from an internal JP Morgan coin to a completely public and decentralized DAO use case without having to give up any of what a blockchain is supposed to be, but also any of the privacy, the control, the scalability issues. So we started working on putting Pact on a public chain, and we found a way to scale proof of work. This is our chain web protocol. It is a parallel chain braided architecture. So instead of having one chain that is, when you make a new block, it only points at its previous block. Instead, you can have, say, two chains. And when a new block is made for either chain, it points at the previous block for its chain and that of its peer chain, that of the other chain. We figured out how to generalize this concept because it's not a totally new concept, and are currently in testnet with Chainweb, running 20 chains braided in parallel on I think it's a 60 node cluster that's globally deployed. And on October 30th, we're going to be going to mainnet launch, probably with between 20 and 50 chains in the initial Chainweb network. The amazing part of Chainweb is that even though it's proof of work, the energy use as you can increase the network size of Chainweb without increasing the overall energy use. So you can actually go from 50 chains and hard fork to 100 chains without increasing the overall energy that's being poured into the mining of the protocol itself. But it's also incredibly safe because you have all of these blocks being mined asynchronously, but in this single network, you end up having lower confirmation times. We're talking on the order of minute, even lower. And you also have much higher safety guarantees. In the same way that Ethereum has a lower confirmation time than Bitcoin because of having uncles included in blocks, and those uncles represent other blocks that were mined but aren't actually being included. We have a similar structure in how the probabilities end up working out that allows us to have a much safer protocol overall.
Wow, that's excellent. Lots to unpack there, and congrats on the progress and the coming mainnet launch. That's incredible. So, I guess if we start on the enterprise section here, I know you guys are moving towards the hybrid structure. What kind of use cases are you seeing on the enterprise side? Like, is the hybrid structure kind of needed from what you're seeing from enterprise clients, or is this just a natural extension of where you're taking the project?
It's a natural extension, I'd say, of where blockchain is going. So you have something like JP Morgan Coin, which runs inside of JP Morgan, and it is useful for them and it saves them a bit of compliance money. But JP Morgan Coin and that entire kind of idea of an application gets its teeth when you can have a private chain that runs inside of a company that is effectively an accounting system on steroids that dramatically lowers settlement time and compliance costs and all these other just kind of business needs that any big company has. But when you run that private chain, you can, with a hybrid approach, make a smart contract on a public chain like Chainweb and then link that contract to the private network. So that smart contract that runs in public ends up looking like the API for other users of the public network to be able to interact with that private chain. And the main thing that this solves is like where people go to integrate and interop between their various different applications. If you're familiar with Cosmos and the hub and spoke network that they are talking about in the Internet of Blockchains, they are mostly talking about having different blockchain applications that are talking directly to each other. And that's kind of the end state, I would say, in maybe 10 to 15 years. But in the meantime, you want to have the integration be much more kind of natural and much more in one place. And that's what the public side of a hybrid platform gives you. It gives you this piece of high throughput public infrastructure that you can deploy a gateway to your private application to so that other people can come on and use it in a way where you're still controlling and guaranteeing the safety and the security and the privacy of really the core data and logic that is running on your private blockchain instance.
I think it's sort of a black box from the outside looking in on the enterprise side. Like, I see a ton of enterprise blockchain press releases, and Amazon and Microsoft are both supporting this with Workbench and Kaleido and a bunch of others. Where exactly do you guys fit into there? Like, do you envision enterprises building private blockchains on AWS and like storing state on the public Ethereum chain? Or are you guys really trying to be like the one-stop shop here, or does that not even work?
It's a good and a bit of a hard question to answer with a lot of precision, just because the space is still very young. I would say long term, what our platform ends up looking like is something pretty close to AWS, where we're doing a lot on the services side, but the services are opt in. And the main difference being that our public chain and our smart contract language and the whole hybrid platform, those are all open source. So people can just come and build on top of it, and we're providing services on top of that. But we are currently actually deployed to AWS right now with our private blockchain, scalable BFT. You can just go and turn on, I think it's an up to 16 node cluster, and or be up and running with one of the fastest enterprise blockchains that's out there in a matter of minutes. So the space and big technology companies, they're getting into blockchain. They see the potential. Blockchains are databases, but they're the next generation of databases. They remove the business continuity issues that you run into as a a legitimate either business or large enterprise. In that disaster recovery and high availability are completely commoditized. Disaster recovery, okay, you're replicating everything because that's how a blockchain works, so that solves that problem. High availability, again, you're replicating everything before you commit it, so you can parallelize the access needs of your clients to the system that you're running. So, everyone from Oracle to Microsoft to Google, and now we see Facebook, Libra, all jumping in to the space and seeing the potential of, okay, these are a new type of database and you can do some new things with them. The main question is going to be, how do we get a network that has both a public and a private, like an enterprise side? Because IBM Fabric it has its issues. One of the bigger issues that IBM Fabric has is that it doesn't have a public ecosystem. It's not like Ethereum where there's a bunch of hackers and entrepreneurs trying to build businesses on it. It's just only for enterprise users, and that type of ecosystem can only ever grow so much. It's probably the single thing that makes Kadena stand apart from a business strategy side from everyone else, is that we have both an enterprise side and a public side, and it doesn't have to be a separate ecosystem. It's one ecosystem that can, the enterprise side can pull from the experiences of the developers on the public side and the entrepreneurs and the developers on the public side can pull from the money that's going to be put into, I don't know, a standards board for Pact or for furthering our formal verification system, because those things are expensive. And one of the best ways to increase the capacity of a public piece of software is to have enterprises using it and funding the open source, the continued open source development of that software. It's one of probably the biggest things that distinguishes us from everyone else.
Yeah, I couldn't agree more on attracting developers and growing out the ecosystem. So I definitely want to get to that too on your public chain plans. And just staying on the enterprise side for a second, I mean, what's your view on the next 1 to 3 years for enterprise blockchain adoption? I mean, I hate to be the one calling it out a little bit, but I mean, I feel like a lot of it was taboo, early on, even as you alluded to. But I'm trying to figure out like what the inflection point will be for enterprises to really jump in and really adopt the tech.
I think the inflection point was Libra's announcement, actually, because that system, whether or not it even launches, that system that they are marketing is a enterprise blockchain. It's not a public blockchain. It's not even really a stable coin. It's an enterprise blockchain where you're getting 27 people together or 27 different companies together to partner to create this application that is going to be run on a private, permissioned, locked down blockchain instance. So whether or not we see whether or not we see an uptick in adoption of the next few months, probably not, because it's going to take a little while for that to percolate. But the question of, is enterprise blockchain going to be a thing, is now answered. You had Facebook and 27 other major companies come out and say, and put their names on, we're actually going to use this tech. We see the potential. So that, I think, when we look back in 3 to 5 years, is going to be the pivot point of, okay, that core question is answered. Now, what this is going to look like over the next few years, I would say, for one, I think many enterprises are going to have their own version of JP Morgan coin, at least as a trial, if not something that's going into production. Two, in the next year, Kadena itself is going to be bringing on several revenue generating applications onto our hybrid platform, and we're going to be demonstrating how you actually can use this technology to offer a new type of product that makes real money. And I think that once we are able to demonstrate that publicly, and all of these applications are through partners that we have, some of which we've announced, some of which we are going to be announcing in the next few months. And once we can demonstrate that you can make real revenue, real profits on a blockchain platform and have a new product that is understandable and tangible, all of a sudden the category of, okay, what do you use a blockchain for, gets defined, gets legitimized, and then it kicks off this flywheel where you have more businesses coming on board because the first movers have proven out the approach and proven out that, okay, you can really actually make money off of this stuff. And there's another flywheel, which is the public side, which is that it's my belief, at least, that the crypto zeitgeist responds pretty well to enterprise and business adoption. I think the Enterprise Ethereum Alliance, in no small part, resulted in the hype cycle that we saw during 2017, 2018.
What have you learned from like the consortium models in enterprise blockchain? Like, I guess the good, the bad. I mean, I guess one thing I think about is I think a lot of people always took issue with enterprise blockchains, and a lot of people thought that there was always like one leader in accepting new entrants and validating transactions and things like that. But I'm sure that's probably not the case with what you guys are building.
It's a really good question. There's a spectrum of different styles of applications. I mean, for Libra, while it's supposed to be decentralized, really it's just going to be Facebook saying yes or no to someone getting in. And then on the other side, you can have totally decentralized consortium applications. But on the whole topic of consortia, I would define them as being very good at producing press releases and very bad at producing actual applications. And the problem comes down to politics. The way that we go about building enterprise applications and hybrid applications for Kadena's platform is that we find a kind of a challenger brand, or we find someone who is an experienced market participant who wants to get into blockchain and sees the potential. And then we partner with them to go and build an application and bring it to launch. USCF is the best example that we can talk about publicly at this point. They are the people who in the 2000s figured out how to make a retail investor be able to get direct access or direct exposure to oil commodities. This was through the USO, I think it's an ETN. And they're just innovators in financial products. And we started talking with them, and they saw the potential of this whole blockchain thing. And when we laid out how our platform works and what you can do with it, they were very quick to see the potential for a new type of financial product that we're really excited to be announcing. I believe it's going to be in August or September, depending on exactly how the next couple of weeks go.
That's awesome. Excellent color. And I guess, like, what do you set the bar for when you talk to enterprises on what they should expect? Like, I know you talked about, you want to be able to make them money, but are there other like guarantees or promises or hopes that you give enterprises when you're talking to them about enterprise blockchain?
One of the ways that we set ourselves apart from the competition when we talk to enterprises is that very quickly people are able to grasp how our platform works. They're able to understand that it is actually a real blockchain, and that their developers actually end up loving the platform and the technology and end up being able to very rapidly iterate on taking a concept to being an actual MVP or even into production. We have numerous examples now of a development team going from not even knowing how to use a blockchain or what programming on top of blockchain looks like, to go from that stage of knowledge to being fully fledged experts and migrating an entire application from EVM or just realizing an application in Pact in the span of 2 to 3 weeks. Generally speaking, a developer takes a few days to learn the language because it's A, designed for lawyers and executives, and B, it's designed for safety. So by designing for safety, it makes it much easier to do this rapid iteration, new product development cycle. So that's one of the things that really inspires a lot of our partners and clients, is this potential for, wow, I can have a fully distributed, incredibly robust blockchain-based solution that is running a product in the span of a few weeks. Whereas if I were to use traditional technologies like normal RDBMS like Postgres or Oracle, and put let's say Go or Ruby between that and then the front end, that process would take anywhere from, I don't know, 3 to 6 months. But because this blockchain technology that Kadena is offering gives you so much of that robustness up front and for free because it's on top of a blockchain, we're able to take idea to reality far faster than we ever thought we could.
That's awesome. So we talked about a lot about what you guys are doing on the enterprise side. Let's switch over to Chain Web for a second, and then at the end we could kind of link this together on what hybrid blockchains actually mean here. So you guys are planning to release Chain Web, your scalable proof of work blockchain, at the end of 2019. I guess, what do you expect out of the launch? Is this going to be a full-fledged mainnet, or is it going to be more of a test net? I guess, what are you basically expecting, and what do you hope to offer with this release?
So what we are launching on October 30th is going to be a full-fledged mainnet. Now, of course, there's always more work to be done on anything, but this is a very feature-complete system. We're not launching without any of the features that we went and talked to the community or to SAFT investors about back in this time last year and even before. So it is a full-fledged. We currently have testnet that's up and running, and that is very quickly approaching being feature complete. And then once it's feature complete and we've finished all the stability checks that we want to, then we go into mainnet. And for the first time, we're not going to have to talk about throughput ever again because it solves throughput. And that's the crazy part of the Chain Web architecture for how it leverages some of the weird parts of proof of work to make an incredibly high throughput, incredibly safe public blockchain consensus, approach protocol. So that is just a game changer. Now, it's going to take a while for the market to understand that, if you were to go and adopt Kadena and all of a sudden the network were to get saturated like Ethereum did with CryptoKitties, that all of the participants in the network, from users to businesses to miners, all of their interests are aligned in that they want more adoption of the platform. So we can actually just orchestrate a hard fork to go from, let's say, 20 chains to 50, which would take you from 200 transactions a second to 500 transactions a second. And then we can do that again and again and again as the demand shows the need to do it. So we can go from 50 to 100 to 1,000 chains to 10,000 chains. Now, on that march, I don't believe that we're not going to see other utilities and other services popping up. I know that Kadena is going to be working on load balancing services. One of the big features of Chain Web is that because it's this parallel chain architecture, you don't have the liquidity problems that you would have by using a layer 2 scaling solution. With Ethereum, if you're going to use something like Plasma, you have to stake out to Plasma. But then if you want to use some other app that's built off Ethereum, you need to destake and then go back and then go on to that other application. It's not the case with Chain Web. You can be on one chain and then directly move your coins in your account from one chain to another. So as we're going through this process, we're going to see the throughput of the network probably starting around 200 to 500 transactions a second as a cap, move up to 1,000, up to 5, then eventually 10,000. I don't really see it needing much more past that. I think we should be using layer 2 scaling solutions well in advance of that, of needing 100,000 transactions a second. Really, at some point, you should just be running a Plasma or a Lightning network that is just for the geographies or for the applications that you care about most. So I live in Brooklyn, so I would be on the local, layer 2 transaction solution that runs for all the Brooklyn, small, medium businesses. But I wouldn't need to be on the one for Chicago, say, because I don't visit Chicago very often.
That's excellent color. And that's really cool to break down layer 2 by geography. I never really thought about it like that. And, when you're talking about high scale on your layer 1, going from, 200 to 500 transactions per second to 1,000 and then 10,000, a lot of people sort of expect the trade-off of decentralization there. How are you guys addressing this? And is Kadena still decentralized despite having this higher scale?
So I would say yes. I wouldn't say that the market as a whole agrees on what decentralized means. I am not of the opinion that if you're going to run a global financial system on a piece of technology, that technology is going to be able to be run on in its entirety on everyone's laptop. So for example, you can replicate all of Bitcoin on your laptop, but Bitcoin doesn't do that many transactions a second. If you really want to put the world economy on this technology, you're going to need somewhere around 10,000 to 50,000 transactions a second just at the base layer protocol. And that type of system, that's a serious financial system. Now, the system is still open, so anyone can join, anyone can mine. It's one of my favorite parts of proof of work is that if you want to start mining, you just go buy some hardware and then you start mining and you're participating. It's not like proof of stake where you have to go buy in, and the people who are already staked, they don't want to lose their stake because they're getting fees, so that could drive up the price rather dramatically and then cause instability in the network. We're using the only proven, open public, proof of work protocol or consensus protocol, which is proof of work. So as you expand from, let's say, 50 chains to 100 to 1,000 to 10,000, that means that at every block height, you go from having 20 blocks, one per chain, to 50 to 100 to 1,000. And as you increase the size, so the throughput of the network, the difficulty on a per block level actually decreases. So if you go from, let's say, 50 to 100 chains, you actually drop the difficulty on a per block level by half because you're now mining twice as many blocks. Now, the security actually goes up just because you're sampling more from the global hash rate. And law of large numbers says that as you have more samples, that the result more closely matches what the real distribution is. And that's how confirmation times work. So as we increase the throughput, it actually becomes easier for individuals to be mining on the network and winning blocks. So the decentralization, in my opinion, increases. Now, if your opinion is that I should be able to run the entire global financial system on my phone, well, I'm sorry. I have serious, experience in fintech, and so does my co-founder. There's just no way to do that. You need a serious deployment if you want to replicate everything. But if you just want to replicate the chains that you're on or you're working with, which is 2, 3, 4, that is a much more doable thing. And you still have all the decentralization, all the safety, and all the trustlessness that you would get from just being on a single chain network, but you get this much higher throughput. So I would say we keep the decentralization, and it actually increases as we increase the throughput, but it depends exactly on your definition.
Given your experience in financial markets, building Kadena and everything there, and especially your views on having all of this on a chain, what's your view on DeFi with Ethereum? Like, do you think that this isn't safe, or do you think that it just won't scale? Or I'm just wondering because the amount of Ether locked in DeFi has certainly grown despite the lack of scale on Ethereum's base layer, but obviously that could run into issues long term.
DeFi is interesting longer term, but to be perfectly blunt, it makes me a little bit sad that is the most innovative thing that we can do with this technology. We're just taking crypto and turning it into structured products that remind me of what crashed in 2008. These things are useful, but really it's just money shifting hands, just like back in 2008. I'd much rather be doing real applications that are really touching the world and are changing things in a fundamental way than just making new types of financial products. And I get it, given the limitations of Solidity and of the EVM, this is pretty much all you can do safely. The second that you try to have two smart contracts interact, you end up with a parity multisig problem, where if I'm interacting with some other contract, if I'm importing it, and it's giving me some price feed, if that price feed contract that I'm pulling in data from blows up, then my smart contract might blow up in such a way that I can't actually unlock it or migrate it. I can't actually go and upgrade it. So you end up in this weird situation where all you can really do are things that are tokens or look like tokens. And the most creative thing that you can do with that is this kind of new class of structured products. And there are interesting parts to DeFi. It challenges the notion that we need an exchange, for example. In some of the stuff we're working on with some clients, we're looking at, okay, how do you structure an ETF today? Like, what are the various pieces? And we realize that if you were to put all of this onto a hybrid blockchain platform, several of those pieces aren't really needed anymore. And one of them is an exchange. Having just a direct peer-to-peer quoting system on a base layer public blockchain, and you can do weird structured product things with it. That's interesting. That's new. But overall, I like DeFi in that it's keeping the momentum of the space going, but it's not where the space is ultimately going. This is the let's say this is the intermission before we get to real business.
We talked about enterprise blockchain. We talked about your plans quickly for your public chain launching. And I just want to zoom out. I mean, a year from today, you have your enterprise solution out there, you have your public chain launched, and hopefully you have enterprises come to you and they want to leverage both sides of this. What's an example application or use case look like in your mind that leverages both the enterprise blockchain side, but maybe also your public chain as well, if there are any right now?
So there are some that we can't publicly talk about yet because they get announced closer to mainnet launch. But a good example that we can use is let's just look at the idea of you have some data that you want to protect. So you want to have it in a much more controlled way than being on a public chain. That's really what a private, a permissioned blockchain, one of its core features is that you get more security, you get more control over who sees what. But by having the public chain, you can then link the results of the smart contracts running on that private chain to a public one. So one example is a partner of ours called Remedy, and they are focused on the healthcare data pipeline. Right now, they're running a pilot. They've been running a pilot, I think, for about a year and a half in Mongolia, tracking vaccine deployment and testing for hepatitis C. And part of what they're doing is using a private blockchain to replicate the individual healthcare data, and they are also using a public chain for just timestamping onto that. Now, we're talking with them because they're interested in doing more than just timestamping onto Ethereum from Quorum. They want to have a private blockchain that has real robust logic that runs in its own controlled, permissioned network, but that has this ability to bridge the gap and go into public so that people who are on the private network can bring either information or can link their account ID with other applications that are running on the public network. So the way that I like to think about it is you have really, really private stuff, and that stuff doesn't even go onto a blockchain. That stuff ends up in like an air-gapped, incredibly locked down traditional database. And then you have some cryptographic, opaque representation of that data that goes onto a private chain. That private chain has the stuff that it doesn't need to be completely locked down, like your I don't know, your social security number. And also by running on a private chain, you don't have to pay for gas, which is one of the other really nice things of having this hybrid model. You can have heavyweight logic running on the permissioned side of the application without having to pay the incredible gas fees that you would need to run that same logic on a public network. And then you have this link to a public network in the form of a smart contract that the permissioned side owns, that because that smart contract has proper governance on it. And that is the on ramp and off ramp for people to get into your application.
It's a great example. And zooming out again, it seems like since you guys are basically touching every part of the crypto ecosystem here, from enterprise to public to the developers with your own packed language, it seems like you guys are competing with, I feel like, basically everyone here. Do you view that as true, or do you see an issue with that, or not? I'm just wondering because, I mean, you're competing with obviously most of the other enterprise blockchain providers. You're competing with the public chains here, and then I guess also the interoperability players because you're linking public and private. Do you guys think that it's winner take all here, or do you think that you guys can all coexist? What's your view there?
It's a very astute question. So our overall view is that there's never going to be one chain to rule them all, but there is going to be one smart contract language to rule them all. Just with databases where they coalesce around the standard that we now call SQL, we think that for smart contracts, we're going to see the same thing. Pact, our smart contract language, is actually what allows us to do all of this. It has just individual features that we knew we needed for enterprise that as we started working more and more on the public side, we realized that, okay, two of the main features of Pact, this notion of key sets so that you can have just native multi-sig be supported from day one, and smart contract governance, it basically replaces the need for the smart contracts built by people like Gnosis for governance or for multi-sig. We have formal verification. That replaces the need for things like Certic for being able to take your compiled EVM code and turn it into something that's hopefully a little bit safer. Pact is a full capabilities model. So if you're familiar with Agoric, it has what that company is building, the main concept that company is structured around. It has that actually baked in just to the packed language as one of the sub features of it. So it's really packed that allows us to go and do all of this. By designing a language that can be looked at as a standard, and we've looked at it as a standard from day one, it means that we can put it onto different consensus protocols. Right now, it's just on Scalable BFT and Chain Web. Soon, it will be on other ones, and it's an open source. Anyone can go and fork it and use it and install it on their protocol. And once we get it out there, our view is that you're going to see a standardization around it as the domain-specific language that is purpose-built for what you need to do on a blockchain. And as that begins to really take hold, you're going to end up with people taking the concepts they tried to build out on things like EVM, or they're trying to build out on Stellar, and they're going to say, you know what, wow, I can do this in just a couple of weeks on Pact, because Pact has all of these other features that I really wish that the other systems we're trying to use have, that I need to realize the vision that I raised and I founded around.
Gotcha. That's awesome. And I appreciate that view on one smart contract language ruling them all. I haven't heard that before. That's super interesting.
Yeah, I think that it comes out of, in no small part, my co-founder's experience at JP Morgan. Before him and I met, he rebuilt a quant trading platform for JP Morgan. And one of the big things that he did was he replaced the GUI, the graphical user interface, the app that sales traders were using to specify a quant trading algorithm for their clients, and replace it with a language for those same sales traders. So what that meant, and this is the crazy part, is that technical non-programmers were now programming quantitative strategies in such a way that in 48 hours they were hitting production. There was no developers on the in between, translating what they plugged into some app and translating that into actual code. It was sales traders who aren't programmers writing code that runs in production and handles millions of dollars every day. And it was an incredibly successful thing that Stewart built. And because of that experience, we had this notion that, okay, we can build a language for more than just developers. And we know that if you're going to have something that everyone standardizes around, it can't be too technical. It actually has to be very easy to learn. So we've had, at this point, actually our lawyers beginning to learn Pact just from being in meetings with us and seeing demos of how the language works. Is not uncommon for a lawyer that we're demoing to, usually their client we're demoing to at the end of a meeting say, hey, you know what, that coroutine thing, those Pact things that I don't really know how to describe it because I'm not a computer scientist, but I understand what they do. This is a multi-step escrow thing. We can do insurance like security with this. Like, do you guys realize that you have completely collapsed this incredibly sophisticated workflow into just a few lines of code? And we'll usually respond with, was the point of Pact. It was meant to be something that is very much specific to transactional business logic into doing transactional business logic in an incredibly safe way.
Just closing out, we'd be remiss if we didn't talk about KDN, your token. Is there anything you can share at this time on the use of the token, potentially supply, or basically any metrics you can share around the use of the token itself?
Yeah, it's used just like Ethereum and Ether is used on that network. Miners mine out coin. People pay for gas and pay for fees with coin, and that's it. That's the value prop of it. The economic model is not designed to be something that's we didn't jump the shark with our economic model. It's very much a bog standard thing that's meant to make everyone happy. More details about that will be coming out probably in the next few weeks. We're currently working on most of the blog posts that describe that model. But right now we're in a in-between period with the lawyers where we're trying to get everything set up from a corporate point of view so that we can actually do go to market on October 30th from a legal and regulatory point of view.
That's awesome. And on funding, you guys recently raised funding, or was that a while ago? I know you guys have some serious backers from CoinFund to Multicoin to Scalar, et cetera.
Yeah, we raised 2 SAFT rounds for a total of 15. That's $15 million last year. Metastable, Multicoin, CoinFund, Scalar, VI from the crypto side, SIG or Susquehanna, and Fidelity from the institutional side, SV Angel and Passport from the VC side, and then a number of other players as well. And that's the last time that we did fundraising. We have the capital to get to launch, and that's what we're completely focused on right now is get this thing up, get it out there, show that you can actually make money with applications on it, and then get us out of, we're not in crypto winter anymore, but we're not in summer yet. And we want to be what brings summer.
Yeah, it's pretty cool that you guys could launch a full-fledged blockchain on $15 million. Meanwhile, there's projects that raised hundreds of millions of dollars that are basically missing at this point.
Yeah, I'm going to go with a no comment on the why.
No worries. That's why you have me. Well, is there anything we forgot to hit on that you'd like to talk about, or did we cover most of the good stuff?
I think that we covered most of the good stuff. I think the main things to note are that you can, come to our website at kadena.io. If you want to go and play around with the language, you can go to pact, that's pact.kadena.io, and you'll actually have a fully fledged web REPL that's running on testnet to go and play with. And you can even do formal verification in your browser. It's the crazy experience. And outside of that, follow us on Discord and Twitter. And we're really excited for the next 6 months and what that's going to bring. It's going to be a lot of fun to not have to talk about throughput anymore. At least for me personally, that's one of the things I'm most excited about.
That's awesome. Well, Will, congrats. And it's definitely going to be a fun next couple of months for you guys. And I wish you the best on the mainnet launch. And thanks so much for hopping on the podcast.
Yep. Thanks so much for having me. It's been great.
Hey everyone, if you enjoyed listening to the episode, please share it on Twitter and LinkedIn and give us a 5-star rating in the iTunes store.